Welcome to part 3 of chapter 16. Like section 2, where we discussed terminology, part 3 of chapter 16 is also one of the more important sections. We're going to look a little closer at financial statements for a manufacturing business. They're slightly different than what you're used to looking at in financial accounting. Financial accounting focused mostly on merchandising businesses. In a manufacturing business, things are a little bit different, specifically with inventory. So our balance sheet and our income statement is going to look a little bit different. Our other two statements, retained earnings and cash flow, they're still pretty much the same. In a manufacturing business, we have different types of inventory. A merchandising business, they purchase their inventory and put it out on the sales floor. There's not much they have to do with it. So they only have one type of inventory, usually, that shows up on their balance sheet. It's usually labeled merchandise inventory. Manufacturers aren't buying their inventory, they have to build it. And because of that, their inventory now changes shape, if you will. They start with materials inventory, which is also called raw materials. That's what I will refer to it as, our raw materials. And your raw materials are all of the small pieces and parts that you will need in your finished product. And it's treated like its own separate piece of inventory where you want to monitor it and make sure you don't run out of anything and purchase replenishments and so forth. Once you receive an order, you start building. And you will go to your materials inventory. You'll pull out the raw materials that you need. And now it's going to change shape. It's going to change from raw materials into work in process inventory. Anything that is in any stage of completion, whether it be 1% or 98% complete, it is now called work in process. Your raw materials will be pulled into work in process as you start putting them together, and within your work in process inventory, there are other costs going into work in process. All of your direct labor, all of your indirect labor, and all of those factory overhead costs, that gets pulled into your work in process inventory. Any cost associated with completing those products become work in process inventory. Once that product reaches 100% completion, then it moves out of work in process because it's no longer in process, it's finished, and becomes finished goods inventory. All of the costs associated with that product while it was being built stays with that product and becomes finished goods with all of its costs rolled into it. So, as I mentioned in the previous video, our product costs are also called inventory costs because those costs get rolled into this inventory and eventually becomes a part of our finished goods inventory cost. All of those product costs are rolled into that finished goods. So here's an example. Up top is Musicland. That's a merchandiser. And there's our current asset section of our balance sheet, and there's our line for merchandise inventory. Below that is Legend Guitars. There's our manufacturer, and our current asset section looks mostly the same except with our inventory. And we very clearly see our three pieces of inventory. There's our finished goods. Those are the finished materials, the finished product that are out on the sales room floor ready to be sold to customers. Finished goods for a manufacturer is the same thing as a merchandiser's merchandise inventory. it is what's for sale, ready to go. Legend Guitars also has work in process. Those are all the guitars that are being built right now for orders or to be placed out on the sales floor. They are in some level of completion. And then there's our raw materials inventory. That's all the little pieces and parts just waiting in our raw material warehouse somewhere, waiting for an order to come in. So the balance sheets are very similar. We just have a few more pieces of inventory for a manufacturer. Now you can guess your cost of goods sold or cost of merchandise sold is also going to be a little bit different between the two. Let me see if there we go. Any of you that took financial accounting with me, when we were in our inventory chapter, we talked about this, if you can see it over here, this formula for calculating inventory. And you start with beginning inventory. What do you have in your inventory? Add in your purchases, and that will give you any merchandise that you have available for sale during that period of time. At the end of that period, you go and count your ending inventory and what you have left, and the difference is your cost of goods sold. And let me throw this up here. Okay, so here we are, an example. Let's say I started the year January 1st and I had $100 worth of inventory sitting on my sales floor. During the year, I also went out and I had to replenish some things. I made $1,000 of purchase of other inventory materials. So I started with $100. During the year, I purchased another $1,000 worth of materials, product to go put out on my floor. So at any time during the year, I had $1,100 worth of merchandise that was available to be sold. The $100 I started with, plus the $1,000 that I purchased. December 31st rolls around, and I go and count, well, what do I have left? I have $200 left on the sales floor of merchandise that I've purchased. So if I started with 100, purchased 1,000, I've only got 200 left. I had to have sold $900 worth of inventory. We're going to assume it was sold and not anything else. All right, so there's a quick recap of how we keep track of our inventory and figure out what was sold. All right, what did I start with? What did I add to it? What do I have left? And the difference has to be what was sold. All right, and again, any of you that had me, I told you to memorize this because it would come back to haunt you in managerial accounting. And here we are, very first chapter, it's already haunting you. So for a merchandising business, it's fairly simple. What did I start with? What did I purchase? What do I have left? There's my cost of goods sold. In a manufacturing business, we aren't purchasing anything. And we have 3 types of inventory. So you're going to go through this calculation, beginning, add in new costs, figure out what you have left, and you're going to find the cost of that particular piece of inventory. You're going to do that 3 times. You're going to do it for your raw materials inventory. You're going to do it again for your work in process inventory. And then lastly, for your finished goods inventory. Manufacturing business, here's our income statement. Again, it doesn't look that much different. Sales are still there. There's my beginning finished goods inventory, right? Because remember, finished goods are the same thing as merchandise inventory for a merchandiser. There's my finished goods inventory, but I don't have purchases. I'm not purchasing my inventory, I'm building it. So I need to figure out what is the cost of that finished goods inventory. I manufactured it myself. All of my direct materials, direct labor, and overhead have gone into that finished goods inventory. So I have to calculate it. It's not as easy as pulling my invoices to figure out how much inventory I purchased. So I add that to my beginning finished goods inventory. That tells me the amount of goods I had available for sale during that period of time. I will again go take an ending inventory of those finished goods, and the difference is my cost of goods sold. All right, so there's your calculation for your finished goods inventory. All right, but what about the other two? What about our raw materials and our work in process? That's going to come from your cost of goods manufactured. So a manufacturing business has a second schedule that has to be prepared that analyzes those other two pieces of your inventory, because that's where all of the costs accumulate for your finished goods. That's where those numbers come from. Hoping that makes a little bit of sense. All right, so again, here's a recap of our formula. There's your beginning inventory plus purchases minus your ending inventory is your cost of merchandise sold. Again, that's your merchandising company. For manufacturing, we don't have purchases. We have to figure out the cost of those goods that we manufactured. And that is a separate schedule all by itself. All right, so let's see if it pulls up an example. Here's our example. I have also uploaded an example. You should be able to see it. I believe it says Chapter 16 handouts, and I wrote on it and tried to highlight some things and underline some things. Your cost of goods manufactured is where you're going to look at and analyze your work in process inventory. Again, what did I start with? What did I add to it? What did I end with? There's my ending. And here is your raw materials. Your direct materials are your raw materials. What did I start with in my beginning raw materials inventory? What did I purchase? Raw materials you have to purchase. What is left in my ending raw materials, and the difference between what I started with, what I added, and what I have left has to be what I pulled out and used to start building my finished goods. So there's the first piece. That is your direct materials number. Your direct materials come directly from your raw materials, and you're going to analyze your raw materials using your little formula. There's a second piece of your cost of goods manufactured, direct labor. You will get that number from the payroll department. We're not going to do anything fancy with direct labor. That number will be given to us. And the third piece is overhead. So there are our three pieces of product cost: direct materials, direct labor, and overhead. You will see those three pieces very clearly on your cost of goods manufactured schedule. Those three pieces added together are your total manufacturing costs. Remember, manufacturing costs are those three things: direct material, direct labor, and overhead. Those costs get added to our beginning work in process. All right, there's the second piece of our inventory. Right, we already took care of raw materials. Now we're going to take care of our work in process inventory. What's in process right now? How much more has been added into our work in process? We've added a bunch of direct materials, direct labor, and overhead. At the end of the year, I'm going to review my work in process and see what's left. What do I still have left in process? What has not, or what's not still sitting in work in process has been finished. Those goods have been manufactured, they are done and complete, and all of the costs associated with them stick with them. And that number, that cost of goods manufactured, let's go back here, comes in here to the final piece. Now you can finish analyzing your finished goods. What did I start with? What was built during this period of time? What do I have left? There's my cost of goods that are sold. All right, so I hope that helps a little bit. So the statement of cost of goods manufactured, it has 3 steps to it. The first step, determine the cost of your materials used. All right, that's your raw materials. What raw materials did I pull out of my raw materials inventory and start putting together into a finished product? Part 2, determine the total manufacturing costs. And again, manufacturing costs are those 3 things. Direct materials, which you will have just calculated. Direct labor, which you will receive from payroll. And then all of your overhead costs. And then lastly, what is your cost of goods manufactured? All right, so here's a flow chart for you. There are 3 manufacturing costs: direct materials, direct labor, and overhead. Again, those 3 things will very clearly be seen on your schedule of cost of goods manufactured schedule. Direct materials that are used and pulled out of inventory become part of your work in process inventory. Anything left unused will sit in the ending balance of your raw materials inventory. All right, direct labor that has been used during the period and overhead that's been used up during the period all become costs of manufacturing and sit in your work in process inventory until it's finished. When the product is finished, it gets moved out of work in process into finished goods and hopefully to be sold. All right, so here is an example, and examples like this are always difficult to look at on video. There's our 3 pieces of inventory: raw materials, work in process, and finished goods. They have given us, there's the materials that we purchased, so we added materials to our raw materials. Direct labor that was used during the year, all the factory overhead that was incurred during that year, the indirect labor such as the janitorial staff and the supervisors, depreciation on the factory equipment. And then we've got those period costs down here, selling expenses and admin expenses. So I would encourage you to look at this, take a minute, try to put it together, see if you can put it in the right order. I'm not going to walk through that because they don't do it as nicely as I would like. But there's step 1, cost of materials used. You go through your formula here for your raw materials. You started with $65,000. You added $100,000. So during the year 2016, you would have had $165,000 of raw materials available for your use. December 31st, you had $35,000 of raw materials left. So the direct materials that you pulled and used were $130,000. Right, so there's your cost of direct materials that you used during the year to start building or finish building whatever product you're putting together. So there's the first number, your direct materials. Direct labor was given, factory overhead was given. There's our total manufacturing costs: direct materials, direct labor, and overhead. And then the last part, what is our cost of goods manufactured? That's looking at what's in process. At the beginning of the year, I had $30,000 of items in some percentage of completion. They weren't quite finished yet. I added to that another $284,000 of cost for more products that were ordered during the year. So during the year 2016, I had total manufacturing costs of $314,000 going on. December 31st, I took an inventory of my work in process, what jobs were still open and not quite complete, $24,000 worth of jobs. So I manufactured and completed $290,000 worth of goods. That $290,000 became finished goods. All right, so there's that. There's our statement of goods manufactured that analyzes raw materials here to get your direct materials cost. This whole thing analyzes your work in process to come up with your total cost of goods manufactured. Everything that was manufactured and completed became a part of your finished goods. So instead of that purchases lined here, I didn't purchase $290,000 worth of inventory. I built $290,000 worth of inventory. Added that to the $60,000 I already had out on the showroom floor. So during 2016, I had $350,000 worth of guitar inventory for sale during that period of time. December 31st, I took my final inventory. I had $62,500 left out on my showroom floor, so therefore I sold $287,500 of guitars. And again, that's my cost. That's not what I sold it for. That's the cost I had in it. There, my sales number, I sold that stuff for $366,000. But the $287,500, that's my cost. That's all of the cost, my raw materials, direct labor, and overhead to get those things completed. All right. Once they're complete, then I analyze my selling and admin costs and figure out, did I have any net income or net loss? And Legend Guitars for that year had a net income. All right, so this whole schedule for a manufacturing company, this is all brand new. Make sure you can complete this. Make sure you understand how it flows, exactly what the lines are. This is one thing you do need to know how to prepare. All right, and I will come back to that.